Late October 1981, a fluorescent-lit office on the third floor of the Bank for International Settlements in Basel. A junior analyst, recently transferred from the accounting division, adjusts the margins on a typewritten table before sliding it into a thin blue folder. The numbers are provisional. They always are. Cross-border liabilities, interbank claims, sovereign guarantees counted twice and then subtracted once. The footnote is longer than the table itself. The task seems routine. Reconcile reported sovereign debt figures submitted by member central banks for the annual statistical bulletin. No speeches, no cameras, just arithmetic. The analyst notices that several countries have revised their numbers upward, not dramatically, but enough to require a methodological note. Some debts are now classified as off-balance sheet contingent liabilities. Others are rolled forward, maturity extended, interest capitalized. He hesitates before adding a small symbol next to one column, an asterisk, almost invisible. It indicates that the figure represents not principal, but accumulated obligation, including deferred interest. The distinction matters technically. Politically, it is irrelevant. The bulletin will be read by central bankers, not voters. When the folder is closed, the number inside it will not alarm anyone. It will not even be quoted. It will simply become the baseline for next year. At the time, the world's total recorded debt is large, but still describable. Governments borrow, corporations borrow, households borrow. The system works because growth outpaces interest and because defaults remain local. Mexico's problems are Mexico's problem. Poland's are Poland's. Everything is contained, segmented, labeled. What the analyst cannot see from his desk is that a quiet structural change has already taken place. Debt is no longer something that sits on a balance sheet and waits to be repaid. It has become something that must be rolled, extended, refinanced, and expanded to keep other debts alive. The arithmetic has changed direction. In the years that follow, the process accelerates without ceremony. During the 1990s, financial liberalization allows capital to move faster than regulation. Governments discover that markets will absorb far more issuance than expected, as long as yields remain stable. Corporations learn that borrowing to buy back shares boosts earnings per share. Households are encouraged to smooth consumption through credit. Mortgages stretched from 15 years to 30, then 40. Each innovation is justified on its own terms. Each looks rational in isolation. By the early 2000s, global debt has multiplied, but confidence has multiplied fast. Risk is no longer eliminated. It is distributed, securitized, tranched, sold. When something goes wrong, the assumption is that it will be absorbed somewhere else. In September 2008, that assumption fails briefly. For a few weeks, the machinery stops. Interbank lending freezes. Balance sheets are questioned. Numbers that once looked solid are revealed to be dependent on continuous motion. Central banks respond not with restructuring, but with liquidity. More credit to stabilize existing credit. The decision is framed as temporary. Temporary measures, however, have a way of becoming permanent when reversing them threatens collapse. After 2008, debt does not retreat. It reorganizes. Sovereign balance sheets expand to absorb private losses. Interest rates are suppressed to make the load manageable. What cannot be paid is postponed. What cannot be postponed is refinanced. The total grows, but slowly enough to avoid panic. By the time the analyst's original table has been superseded by digital dashboards and real-time reporting, the distinction marked by his small asterisk has disappeared entirely. Interest is no longer something separate from principal. It is folded in, assumed, normalized. A decade later, during another quiet meeting in Basel, the aggregate number is mentioned in passing, not debated, just acknowledged as a reference point. It is so large that no single institution is responsible for it, and so dispersed that no single balance sheet carries it fully. It exists everywhere and nowhere at once. The mechanics are straightforward. Governments issue bonds to cover deficits and refinance maturing obligations. Central banks purchase those bonds to stabilize markets. Commercial banks create credit against them. Institutional investors hold them as safe assets. Households and pension funds depend on them for income. Each participant sees only their segment. No one sees the whole structure as something that could be unwound. The system functions because it must. If expansion stops, servicing becomes impossible. If servicing becomes impossible, confidence breaks. So expansion continues, quietly justified by necessity rather than choice. By the early 2020s, the number has grown beyond comparison. It is larger than global output, larger than global trade, larger than the productive capacity that supposedly supports it. Yet daily life adjusts, markets open, payments clear, salaries arrive. Nothing appears broken. The debt is no longer discussed as something to be repaid. It is discussed as something to be managed, rolled forward, stabilized through policy coordination. The language shifts from obligation to sustainability. What began as accounting has become infrastructure, and somewhere inside the aggregate, the original question that once justified the analyst's asterisk has lost its place in the reports. Not because it was answered, but because answering it would require stopping the motion that keeps the structure standing. The numbers continue to be updated. The folders are now digital. The tables refresh automatically. The system counts itself, and as long as it does, it remains alive. Early March 1997, a modest conference room inside Thailand's Ministry of Finance. A mid-level official reviews a spreadsheet printed that morning, its columns shaded in pale gray. The numbers show short-term foreign liabilities coming due within 12 months. They are large, but not unprecedented. The exchange rate has been stable for years. The assumption, written nowhere but understood by everyone in the room, is that refinancing will be available. The official signs off on the report and forwards it upward. The figures will be incorporated into a regional assessment circulated among multilateral lenders. No alarm is raised. Similar tables exist in Jakarta, Seoul, São Paulo. Each country's situation appears manageable when viewed alone. What is not visible in the room is the symmetry. The same banks have lent to all of them. The same currencies denominate the debt. The same confidence underwrites the rollover. When Thailand's currency breaks a few months later, it is described as a local imbalance. When Indonesia follows, the explanation expands. When South Korea is forced to request emergency support, the language shifts again. Contagion, liquidity, mismatch, confidence, shock. What never enters the official summaries is that the liabilities did not disappear when currencies collapsed. They were transferred, absorbed by international institutions, restructured, extended. Losses were socialized upward, then outward. The debt survived. Only the holders changed. This pattern repeats with quiet consistency. Latin America in the 1980s, Asia in the 1990s, the United States and Europe after 2008. Each crisis is framed as unique. Each resolution relies on the same mechanism: prevent default, maintain continuity, expand balance sheets if necessary. By the time global debt passes thresholds once considered extreme, the system has already adapted to them. Ratios that would have triggered panic decades earlier are now discussed in footnotes. What matters is not the size of the obligation, but whether payments can be serviced this quarter, this year, this political cycle. Debt stops being a moral concept. It becomes an operational one. In policy circles, the question shifts subtly. It is no longer who owes what, but who holds what, because holding implies stability. It implies assets, not burden. When debt instruments are widely held by pension funds, insurance companies, and central banks, they are recast as saving, as security, as the foundation of retirement systems and financial stability. The same liability appears twice, wearing different labels. A government bond is debt to the issuer. It is wealth to the holder. Multiply this logic across borders, currencies, and institutions, and the aggregate number begins to lose its meaning. Every obligation is mirrored by a claim. The ledger balances even as the total grows. This symmetry becomes the system's primary defense against scrutiny. If every debt is someone else's asset, then questioning the debt is questioning the asset. Questioning the asset is questioning stability itself. So the discussion narrows. Analysts debate duration risk. Central bankers debate yield curve. Regulators debate capital buffers. No one debates the necessity of perpetual expansion, because contraction would collapse both sides of the ledger simultaneously. During the 2010s, a new justification emerges: low interest rates. As long as borrowing costs remain below growth rates, debt is said to be sustainable. The argument is mathematically sound within its assumption. It also requires that rates remain low indefinitely, or that intervention suppress them when they threaten to rise. This transforms monetary policy into structural support. Central banks are no longer referees. They are participants, buyers of last resort, stabilizers of markets whose scale exceeds any private capacity to absorb shocks. The balance sheets expand. Quantitative easing becomes normalized. What was once extraordinary becomes routine. In internal documents, the language remains careful. There is no mention of dependence, only accommodation, only adjustment. By the early 2020s, the global number has grown so large that it cannot be contextualized. Comparisons to GDP feel abstract. Trillions lose their emotional weight. The figures are repeated so often, they become background noise, like atmospheric pressure, always present, rarely noticed. Yet beneath the abstraction, the structure tightens. Short-term refinancing grows more important. Market confidence becomes more fragile. Policy coordination becomes less optional. At the same time, public discourse drifts in the opposite direction. Debt is discussed as a political tool, as stimulus, as investment, as something future growth will resolve. The question of final settlement quietly disappears. In private, some officials acknowledge the implication. The system does not require repayment, it requires continuity. Debts are rolled, not retired. Principal is refinanced. Interest is capitalized. The end state is never zero. It is infinity managed through policy. But this understanding is never formalized. It remains implicit, passed between meetings, embedded in assumptions, reflected in models that do not include terminal conditions, because a system built on perpetual rollover cannot admit that it has no exit without destabilizing itself. And so the number grows, not because no one sees it, but because seeing it clearly would force a question that the structure is not designed to answer. The question is not how large the debt is. The question is, what would happen if the process that keeps it moving were allowed to stop? Mid-June 2014, a windowless operations room inside a large pension fund headquartered in Northern Europe. A portfolio manager scrolls through a risk report while a junior associate waits nearby. The fund manages retirement savings for millions. Its mandate is conservative. Capital preservation first, yield second. The problem is visible immediately. Government bonds, once the anchor of the portfolio, now yield almost nothing. In some cases, less than nothing. The numbers look wrong, but they are correct. Investors are paying governments for the privilege of lending. The portfolio manager does not debate the absurdity. Absurdity has already been normalized. The discussion is technical. Duration targets, liability matching, regulatory requirements. Retirees will need income regardless of macroeconomic conditions. The solution, approved quietly, is to move outward along the risk curve. Slightly longer maturity, slightly lower rated sovereign, a modest allocation to corporate credit. Nothing radical, just enough to meet actuarial assumptions. The debt absorbs the demand without protest. Across the system, this same adjustment is happening everywhere at once. Insurance companies, endowments, sovereign wealth funds, each institution responds rationally to its own constraints. Together, they form a single, enormous buyer of obligation that cannot realistically be extinguished. This is how the question becomes unaskable. Every major constituent now depends on the continuation of the structure. Governments depend on borrowing to function. Markets depend on liquidity to price assets. Savers depend on debt instruments to fund retirement. Central banks depend on stable markets to transmit policy. There is no neutral observer left. In this environment, asking who ultimately carries the burden becomes destabilizing by definition, because the burden is distributed so widely that identifying it feels like accusation. If debt is everyone's asset, then questioning debt sounds like questioning everyone's security. So the framing shifts again. Debt is no longer discussed in terms of obligation, but in terms of capacity. Can it be serviced? Can it be rolled? Can confidence be maintained? The horizon shrinks. Long-term settlement disappears from view. During crises, this logic becomes explicit. When markets seize, central banks step in not to resolve imbalances, but to restore motion. Liquidity facilities are opened. Asset purchases are expanded. Lines are drawn between institutions to ensure funding does not break. Each intervention is justified as temporary. Each one leaves a residue. By the time the emergency passes, balance sheets are larger, dependencies deeper. The system has been preserved by adding more of the thing that required preservation. What is rarely stated is that this approach works only as long as expansion remains politically and psychologically acceptable. It assumes that confidence can always be manufactured faster than doubt, that credibility can always be restored through scale. The question that hovers just outside official language is simple but dangerous. If every layer relies on rollover, where does the chain end? In academic papers, this is addressed abstractly. Infinite horizon models, representative agents, steady states that assume continuation. The math is clean because the premise is never tested against interruption. In practice, interruption is avoided at all costs. Consider what repayment would actually mean. Large-scale debt retirement would require surpluses. Surpluses require either austerity or growth far beyond historical norms. Austerity destabilizes politics. Excessive growth destabilizes resources. Neither path is neutral, so the alternative is chosen by default. Extend, refinance, reclassify, rename. Language becomes an essential tool. Deficits become investment. Borrowing becomes stimulus. Central bank purchases become normalization. The words are precise enough to function, vague enough to soothe. Meanwhile, the aggregate grows, not because of conspiracy, but because of alignment. Every actor, following institutional logic, reinforces the same direction of travel. No one is tasked with asking whether the destination exists. At some point, the scale crosses from large to symbolic. Trillions no longer represent projects or promises. They represent continuity itself. To question the number is to question the operating system. This is why the question rarely appears in public discourse. Not because it is forbidden, but because it is incompatible with the roles of those who might ask it. Politicians cannot ask it without implying limits. Central bankers cannot ask it without undermining confidence. Institutions cannot ask it without unsettling their own balance sheets. Even critics tend to stop short. They argue about distribution, about fairness, about inflation versus deflation. They debate symptoms. The underlying arithmetic remains untouched. And so the system proceeds as if the question has been resolved, when in reality it has been deferred indefinitely. The burden is carried forward in time, assigned to growth assumption, future policy coordination, future productivity. No ledger shows who will ultimately absorb it, because absorption is not an event. It is a process, a slow transfer, a gradual dilution, a normalization of what would once have been unthinkable. The question persists, not as a headline, but as background tension. It does not demand an answer today. It only requires that tomorrow resemble yesterday closely enough for the machinery to keep running. For now, that condition holds. Early February 2020, a nondescript government building a few blocks from a major central bank. A policy aide sits alone at a long table, reviewing briefing notes prepared overnight. The agenda is narrow: contingency planning. Market volatility has increased. Supply chains are under stress. Forecasts are being revised down, then revised again. One slide stands out. It shows projected borrowing requirements under several scenarios. The most severe line extends far beyond previous crises. The aide does not react emotionally. That stage has passed. Instead, he notes the assumptions in the corner of the page. Rates near zero, full market absorption, central bank backstop activated if needed. The implication is clear. Whatever happens, funding will be provided. When the shock arrives weeks later, the response is immediate. Fiscal packages are announced in numbers that would have been politically impossible months earlier. Central banks expand balance sheets at unprecedented speed. The debate is not about cost, but about sufficiency. Not whether to act, but how much. The question of accumulation never enters the conversation. What follows is described publicly as emergency response. Privately, it is understood as acceleration. Programs that once required years of justification are deployed in days. Debt issuance surges. Purchases surge faster. Markets stabilize not because fundamentals improve, but because interruption is removed as a possibility. In the aftermath, something subtle changes. The psychological ceiling on numbers disappears. If trillions can be created in weeks without immediate collapse, then previous limits were not economic. They were political. And political limits, once crossed, rarely return to their original position. In the years that follow, borrowing remains elevated even as the crisis recedes. Temporary measures are extended. Support becomes baseline. New justifications replace old ones. Climate transition, strategic investment, resilience. Each goal is defensible. Each requires finance. The mechanism is already in place. At this stage, the system is no longer oriented toward repayment, even in theory. It is oriented toward maintenance. Debt supports growth assumptions. Growth assumptions support debt sustainability. The loop is closed. Within this structure, the idea of a final bearer becomes increasingly abstract. Households feel the pressure through prices, taxes, and asset inflation. Governments feel it through constrained policy choices. Central banks feel it through expanded mandates they never formally requested. But none of these actors are identified as the carrier of the total weight. The load is diffused through time and population, spread thin enough to avoid rupture, concentrated enough to remain invisible. Inflation, when it appears, is treated as a technical problem. Too much demand, supply friction, expectation. Tools are adjusted. Rates are raised cautiously, then paused. Balance sheets are discussed as if they could be reduced without consequence, even as markets signal otherwise. The reality is more rigid. Every attempt to normalize reveals dependency. Markets react not to fundamentals, but to withdrawal of support. The message is consistent. Reduction is possible only if replacement demand appears. If it does not, intervention resumes. This is not policy failure. It is structural constraint. At this point, the system resembles a large institution that cannot shut down for maintenance, because shutting down would cause collapse. Repairs are done while it is running. Additions are bolted on externally. The original blueprint is no longer referenced. From the outside, the number appears grotesque. From the inside, it appears inevitable. Those who ask where it leads are often redirected toward distributional debates. Who should pay more taxes? Who benefit from asset inflation? These are real questions, but they operate within the assumption that the aggregate itself is untouchable. What is never addressed directly is that the aggregate represents claims on future output that has not yet been produced and may never be produced at the scale assumed. The system bridges this gap through confidence, policy coordination, and the expectation that adjustment will be gradual rather than abrupt. Gradualism becomes the core strategy. Small erosions are preferable to sudden breaks. Purchasing power adjusts slowly. Obligations are honored nominally, while changing in real terms. No single moment can be identified as resolution. This is why the question remains unanswered. Not because no one knows how the system works, but because answering it honestly would require admitting that the burden is not meant to be lifted. It is meant to be carried, redistributed, and diluted across generations. The future is not asked to repay the past. It is asked to absorb it. So long as societies accept this trade, the system holds. The moment acceptance falters, the mechanisms shift again. Controls replace market. Mandates replace incentives. Stability is preserved through different means. From within, these changes feel technical. From outside, they appear ideological. In reality, they are logistical responses to a structure that cannot reverse without undoing itself. The number, by now, functions less as a measurement than as a boundary condition. It defines what must not fail. Everything else is negotiable. And so the question continues to circulate quietly, understood but rarely voiced. Not who owes, not who lends, but who ultimately adjusts when adjustment becomes unavoidable. The answer is never written down. It emerges slowly, through policy choices that feel temporary and through outcomes that feel disconnected until they are not. Late August 2027, a regional tax office in a mid-sized city. A senior civil servant reviews updated revenue projections on a muted screen. The numbers are not catastrophic, they rarely are. Growth is modest, collections are slightly below forecast, expenditures are locked in by legislation passed years earlier, debt service sits at the top of the outflow column, non-negotiable, automatically executed. The adjustment required is small. It always is, at first. A temporary surcharge here, a bracket adjustment that does not quite track inflation. A fee reframed as modernization. Each change is defensible in isolation. None of them are described as responses to debt. They are responses to need. Across the economy, similar adjustments appear without coordination. Utility prices edge higher. Insurance premiums reset. Asset prices rise faster than wages. Savings lose purchasing power slowly enough to avoid headlines, fast enough to alter behavior. No announcement connects these shifts. There is no press conference explaining redistribution, yet the effect is consistent. Claims on the future are being honored through quiet, present-tense erosion. This is how the burden moves. It does not arrive as a bill labeled global debt. It arrives as altered terms, as expectations recalibrated downward, as standards quietly revised. Each generation absorbs what seems normal to it, unaware that the baseline has shifted. In financial markets, the process is framed as repricing. In policy language, as adjustment. In everyday life, it appears as a sense that effort yields less margin than before. The structure depends on this ambiguity. If the burden were assigned explicitly, it would provoke resistance. If it were calculated openly, it would invite comparison. Instead, it is diffused across time, demographic, and mechanisms that appear unrelated. Inflation plays a role, but not alone. Taxation adjusts, regulation expands, returns compress, public services are redefined. None of these are framed as repayment. They are framed as modernization, sustainability, resilience. Debt remains untouched in nominal terms. Bonds are honored, coupons are paid. The ledger balances. What changes is the real value of what those payments represent. This is not accidental. It is the only method compatible with scale. Large systems cannot resolve large imbalances directly. They can only smooth them, stretch them, translate them into forms that can be socially absorbed. From within the system, this appears responsible. Abrupt correction would be destabilizing. Gradual adjustment preserves continuity. Policymakers are rewarded for avoiding crisis, not for resolving structural arithmetic. So the incentives align with postponement. At the same time, narratives evolve to support the process. Intergenerational solidarity, investment in the future, shared responsibility. These phrases are not false. They are incomplete. They describe the motion without naming the force behind it. In private discussion, the reality is understood more clearly. Long-term projections assume lower real returns. Retirement ages creep upward. Benefit formulas are adjusted. Expectations are managed quietly, years in advance. The future is prepared to accept less without framing it as loss. This is the closest the system comes to answering the question, not by naming a bearer, but by dissolving the concept of bearing altogether. The weight is not carried by one group or one moment. It is spread thinly enough that no single actor can point to it and say, "This is it." The debt remains intact. The adjustment happens elsewhere. When tensions surface, they are interpreted through political lenses, generational conflict, inequality, cost of living. These debates are real, but they orbit the core rather than confronting it. The core remains protected by complexity. Every attempt to simplify the story is redirected. Debt is offset by assets, obligations by claims. The ledger always balances. What does not balance is experience, but experience is subjective and therefore dismissible. And so the system continues to function without resolving the question, because resolution would require concentration, and concentration would require acknowledgement. The question persists only at the edges, raised by those who notice that stability increasingly depends on adjustment without consent. That continuity requires quiet participation from those who never agreed to the terms. By now, the number itself is rarely mentioned. It has served its purpose. It justified expansion when expansion was needed. It now recedes into the background as the mechanisms it enabled take over. The system no longer needs the figure to operate. It only needs acceptance of the process, and acceptance, cultivated slowly, is far more durable than agreement. Early April 2033, a quiet weekday morning inside a commercial bank branch that has recently been redesigned to feel less like a bank. The counters are lower. The signage avoids words like debt or credit. Customers sit with advisors who speak in terms of planning, optimization, resilience. A middle-aged couple listen as projected retirement figures appear on a tablet. The numbers are sufficient according to the model. Not generous, not alarming, just enough. The assumptions are conservative, the advisor explains. Real returns adjusted downward. Longevity assumptions adjusted upward. Nothing unusual. No one mentions why these adjustments have become standard. Across the economy, similar recalibrations are taking place. Long-term promises are rewritten without fanfare. Pension formulas evolve. Social benefits are indexed differently. Contracts remain valid, but their real meaning changes. The system honors its obligations by redefining what fulfillment looks like. This is not collapse, it is convergence. The distance between what was once expected and what is now delivered narrows slowly, not through repudiation, but through normalization. Each step is small enough to be defended, each one framed as realism. From a policy perspective, this is success. Markets function, payments clear, institutions endure. There is no single shock to point to, no dramatic failure. The machinery continues to operate, which is the primary objective. From a historical perspective, something else is happening. The question that once hovered over the system has been answered, not with a declaration, but with a method. The burden is not assigned, it is dissolved. Future income is partially preclaimed through lower purchasing power. Labor absorbs it through longer participation. Savers absorb it through compressed return. Consumers absorb it through prices that rise faster than nominal wages. None of these mechanisms appear on a balance sheet labeled global debt. Yet together, they perform the function that explicit repayment never could. This outcome was not planned in a single room or authored by a single institution. It emerged from constraints interacting with incentives, from the impossibility of reversing scale without rupture, from the preference for continuity over correction. Those inside the system understand this implicitly. They speak of managing expectation, maintaining confidence, avoiding disorder. They do not speak of resolution, because resolution implies an endpoint. The system has no endpoint. What it has instead is a logic. Obligations expand when expansion is required. Adjustments occur where resistance is lowest. Time is used as a buffer, complexity as insulation, normalcy as camouflage. This is why the question was never meant to be answered publicly. Not because the answer is hidden, but because it is incompatible with the story societies tell themselves about choice and control. The answer is not a person, a country, or a class. The answer is duration. The longer the system operates, the more the burden is converted from a visible number into lived condition. The number fades, the conditions remain. By the time this is widely felt, it no longer feels imposed. It feels inherited, as if it has always been this way. That is the final transformation. Debt ceases to be a problem to solve and becomes a background parameter of reality, like interest rates once were, or inflation, or growth. Those who come after will not ask how the number was accumulated. They will ask how to live within its consequences, and the system will provide tools, products, narratives to help them do exactly that. The question will still exist, archived in reports and old debates, but it will no longer matter operationally, because by then it will already have been answered, not with words, but with time.